Hi, everyone. Thank you for your patience. We're waiting for, we have a lot of attendees on the call today, so I wanted to give everyone a chance to log in. My name is Devin Cranson. I'm the founder and president of Cranson Capital, and I appreciate your time today. We're going to go through a presentation on our view of the real estate development market in 2024, and then we're going to talk about the Cranson Capital Real Estate Development Fund and let you know how you can participate. And then at the end, we will have a question and answer. If you do have a question, there is a question tab on the GoToWebinar app, and feel free to go ahead and ask your question at any time. I won't address them till the end, but you can definitely put them in along the way. I already see someone saying that they're having some technical difficulties, not able to hear. We've confirmed that's not an issue on our end, so that must be on your computer. So hopefully you can fix the sound. And with that, I will get right into it. So we always put this disclaimer up. You don't need to read it while you're on the webinar, but if you do decide to invest, as it says at the bottom, any investment in the Cranson Capital Real Estate Development Fund will require the investor to review the offering documents. And so you will have a chance to read all the disclaimers before you make an investment. So I'll give you a quick intro to Cranson Capital. We're an exempt market dealer. We specialize in private market Canadian real estate investment opportunities. We're registered in Ontario, Quebec, Alberta, BC, and Newfoundland. We look at 4 areas: land for future development, real estate development, income producing real estate assets, and niche real estate assets. Today we have raised $320 million. We have 24 active projects. You can see mostly GTA based on the map there, and completion value of over $3 billion. I've also been awarded from the Private Capital Market Association the Deal of the Year award 6 times. So great track record of success. Just going to talk about a couple of our transactions. We raised $8.4 million in May 2020 for Profile Developments to build the Huntingdale Towns Limited Partnership. This is a townhouse project in Scarborough. It's already about 96% sold. It's under construction, about 1.5 years from completion. And when we originally did the deal, we told investors they probably would make, I think it was 110%. Today, it looks more likely there'll be 160, 165% return, so doing really well. The next one I'll talk about is the 5888 Yonge Street Fund. This, we raised $17.5 million back in July 2016. It's been a long time, but it took us 5 years to get zoning. But the good news is we had a huge land lift through that 5-year period. And when we went to do our pre-sales, we did really well selling in spring of 22. And we were able to go to the bank and get enough on the construction financing to return 80% of the equity to investors. So investors have gotten most of their money back, and now the project's well under construction and on pace to generate a 200% return for investors. So a great story there. And the Block Vaughan Road project is a mid-rise building near Bathurst and St. Clair. We raised $5.65 million in October 2019. They also launched sales in spring of 2022, kind of before the market changed. They did really well getting to their pre-construction threshold, and now they've started construction. And also, when we did the deal, we were talking about 120% return, and now their projections are calling for 170% return. So 3 great examples of great deals that have progressed really well and will be great outcomes for investors. So now I just want to talk a little bit about the market. It's a very confusing market, and yesterday was lucky enough to attend the Real Capital Conference and hear from lots of industry experts and kind of saying the same things that we're seeing. So a great validation for us, and I'm going to try to share some of that in this presentation. So obviously interest rates are affecting costs and buyers. And so you can see from this graph, these are the housing prices when interest rates were kind of low. The prices kept going up, interest rates were going down, and all of a sudden interest rates start going up, and look what happens to house prices. They start to come down. And so you can see the impact directly there on this is on resale pricing, but obviously in pre-construction, interest are a bigger factor, because not only does the pre-construction buyer have to deal with it, but the construction project has to pay interest on their construction loan. So it ends up being more expensive to build, and the buyer has less buying power when interest rates are higher. And so this lack of affordability really limits new housing starts, because the way pre-construction works in Canada, you have to sell a certain amount of the building in pre-construction in order to get your bank financing. And if you can't show the bank that you've sold it at a price that gives you at least, say, a 10% profit margin, the bank won't give you the bank financing. So if you don't get your pre-sales, you won't get your construction financing, and you won't start. I heard a stat the other day that there were 32 projects that went to launch in the fall of 2023. And of the 32 projects, only 5 reached their number to be able to start. So 27 projects that are now delayed or shelved and will not get started. And so when we look at the starts, we can see the starts were, getting up to 100,000 at one point and have significantly dropped off and are expected to drop off even more. Meanwhile, the government is saying we need 150,000 starts a year. We're not coming anywhere close to that number. So we're actually making the housing affordability problem worse. And we're still driving our population growth. It's still driving demand. And you can see here, this is the 4 million people coming to Ontario over the next 15 years. The Ontario government and CMHC have said that we need to build, well, CMHC has said we need to build 3.5 million homes across the country to accommodate the population growth. And we are not coming anywhere close to that number. So long term, we need to continue to build housing. But if you look here at housing completions, we look like we were off to a decent way to get better from 2016 to 17 to 18, and then a big drop off. And we're going to expect to see that continue. Now, what's a little confusing about the market is that in 24, we may actually have quite a bit of completions. Those were projects that started in 2018. But what we're going to see going forward, if you think forward, in 23, there were not a lot of starts. In 24, there won't be a lot of starts. It means that in 27 and 28, we will have a huge drop off in completions. So what do? You need to build housing, but you can't get the pre-construction sales the way that you used to. And so we're focusing on end user product. People still need a place to live. When I talk about the pre-construction market, a lot of times we're talking about investors buying product that they're going to rent out when it's finished. And a lot of times in high rise, you need that because it takes 4 or 5 years to build. And an end user doesn't want to buy, generally doesn't want to buy a condo that they're going to live in and have to wait 4 or 5 years to move in. There are certain circumstances for sure where that happens, but much more likely that someone's going to, an end user is going to buy a single family, a semi, a townhouse, or even a mid-rise building that will only take 2.5 years to build. So we're looking at end user product being the most viable. Now, it doesn't really do a huge dent in the need for housing. Obviously, if you're building a high-rise, you're going to build 500 plus units, and if you're building a townhouse project, you're going to be building 80 to 100. So you're not really, doing so much against the need, but at least you're providing some housing, and it's housing that will sell in pre-construction because people need a place to live. And the end user can see if they're buying a townhouse that they can move in 18 months after they buy or 2 years after they buy. So our focus in 2024 is on end user product. The other thing that we think has become a lot more viable is purpose-built rental. We have a huge need to build purpose-built rental. And you can see here that, through COVID, our vacancy rates jumped up, but since COVID, it's dropped back down. This is the GTA vacancy, but I think it's a similar story in most major urban markets across the country, where vacancy in GTA at least is 2.5. I think it's below 3% in most places across the country, and that's why you're seeing rents continue to grow. And they will continue to grow. As I said, if no new starts happen in 23 and 24, think about where the rents are going to be in 27, 28 when nothing is being added in completions, and the only stuff is the purpose-built rental, which is a small amount compared to what's been built in the past. And so the government's trying to help. I think the provincial government's doing some stuff as well, but the Canadian Housing Action Plan they came out with in the fall was interesting. They're focusing on accelerating zoning timelines, which does help. Obviously, a big bottleneck is how long it takes to go from purchasing a product to purchasing land to getting it zoned. So speeding that process up is going to lower the timeline and therefore lower the cost. So that will be a big help. The big one is the removal of HST on purpose-built rentals. Now, this represents about 9 to 10% of a rental building's budget, which is similar to what the land cost is, just to put that in perspective. So knocking that off the budget is huge savings for the developer and definitely makes it a lot more viable. One of the things that I think would be interesting is if they consider knocking HST off of regular home buyer units, all new construction, and that would definitely accelerate a lot of the market. We're seeing a lot more federal lending programs for purpose-built rental. Again, you know, they're trying to level the playing field with condo developers. In a condo, when a developer pre-sells, they get deposits and they can use those deposits in their construction budget. So the equity check that's required on a condo is generally between 10 and 15% of the total cost of the building. In the past, rental projects, purpose-built rentals, could only get 75% loan to cost on their construction financing. So if someone were to build a rental building, they'd have to come up with 25% equity. If you can come up with 10 to 15 and build a condo versus having to come up with 25 to build a rental, every time you're going to pick a condo, it's going to just be much better returns for the equity investors. The federal government's come out with some programs under the CMHC, one called MLI Select, and the other one has a new name, but used to be the RCFI program. And those programs can get developers up to, I think in the RCFI program, up to 100, but let's say 85, 90% loan to cost. Now there's other rules that kind of restrict the availability, and a lot of developers in certain markets will say it's hard to get 90, you might be stuck at 85 or 80, but there's definitely markets where you can get even 95. So that's a big help. I think the CMHC should try to level the program so it works in every market. But it's definitely helping in all markets. Some markets it's helping a lot more than others. The other part of that is speeding up the CMHC loan applications, which we think they have, but for the last 2 years, it's taken a really long time for any builder to get a CMHC certificate. So one of the things the government announced in the fall is that they're going to speed that up, and I think that we've seen that very recently actually happen. They also talk about bringing in more construction workers. One of the little known facts is that even if we had all of the zoning approvals and all of the pre-sales and we were ready to go and build, that I showed before that we need 150,000 starts a year. If we were ready to do that, we don't have the labor. So I think the labor force is a big issue. I don't know where it kind of taps out, but we've never built more than 75,000 homes a year, and I don't think that we have the labor to do that. And what we see in the labor market in construction is that it's shrinking. People are retiring, and there's not a lot of new workers coming into the industry. So it's a big issue. It's been talked about for a couple of years, and now the federal government is taking it as part of their action plan to try to get more construction workers. And so just to kind of summarize what I'm saying and what our kind of view is on real estate development in 2024, the lack of affordability is going to limit the pre-construction buyers, which will limit new launches, and it will also limit land transactions. You're going to see immigration continue to fuel record high population growth. We don't even have enough homes for the people that are here now, but we're going to continue to bring in more. And I don't think we should slow down immigration. Back to that workers comment, I think that we have a lot of people in the workforce in construction and outside construction who are looking to retire in the next 5 to 10 years, and we need to bring in immigration to keep our labor force intact. Long term, we need to build more housing and the right kind of housing. And so we're focusing right now on end user and townhouse projects being the most viable. And when I say end user, again, there's some mid-rise projects that we think are end user as well, and low-rise projects, single family homes, end user as well. So not just townhouse, anything where we think the buyer will be the person who's actually going to live in the home and not an investor. We do want to see investors help on the purpose-built rental side, and the HST removal and CMHC financing programs are starting to help purpose-built rentals get built. And so we're hoping that we can participate in that and raise some money to invest in purpose-built rental buildings in 2024. And obviously the pressure for faster zoning timelines is going to help. It's going to shorten the entire cycle. You know, I have so many probably investors on this call who have invested with us before, and the biggest complaint is that it always takes longer than we expect it to take, and that's almost always been, obviously COVID was a part of it, but in general, it's almost always been the zoning timelines. It's that we had to appeal to the tribunal, or we had to go back and redesign, or we just had issues with the planning department. I believe that that's changed. The last two submissions that we had to planning had a very different reaction, and I'll talk about those later on when I talk about those two projects. And we see the federal government putting up all kinds of money for the municipalities to speed up the zoning timelines. So we think that, you know, when we say a deal's 5 years, people look at us and think it's more like 6 or 7. I think today when you say a deal's 5 years, you can believe it's actually going to be 5 years. And we're seeing construction costs start to moderate. And I don't know how long that's going to last for, but what we've heard is, at least in this quarter, that construction costs are down 8 to 10%, depending on what type of project and what area of the construction. That's really a sign that there's not a lot of starts. And so the construction industry is looking for work and competing. So that's a big change. It hadn't been that way for 10 years. It was really hard to get certain trades, and you had to book them well in advance, and their schedules were fully booked. And so the costs continued to escalate. I don't think that they're, you know, going to decelerate to a significant, you know, reduction, but the 2023 increase is pretty much erased, and we're back down to 2022 construction prices at the moment. But the big one is obviously interest rate relief. And if you listen to Benjamin Tal, CIBC economist, yesterday, he believes that we're going to start seeing some reductions in June and some more in the second half of the year. And he has a target for the Bank Canada rate to get to 3% at some point in 2025. So that's welcome news. I'm not going to make those type of predictions, but I'd love to share his predictions, because he's one of the experts and a much better person to make those predictions than me. But obviously that interest rate relief will be huge. We're already starting to see it, because we've seen the bond market impacted by some of the comments that the government has made, expecting interest rates to come down. So if you look at the 5-year bond, which is the mortgage, what affects the mortgage market, it's started to come down already. We've started to see just in the spring a real pickup in activity on single family homes resale. And that's just a sign of things to come. We expect the condo market and resale to pick up over the next couple of months. And obviously, as we get closer to a rate reduction or changes in the mortgage rates, it's going to fuel more activity in the buyer side, and then you'll eventually see some relief on the construction budgets when developers are paying interest at a lower rate than they are today. And so now I'm going to talk about our fund, the Cranson Capital Real Estate Development Fund. So we're raising up to $25 million. We're going to invest in a pool of 4 to 6 residential developments. We've already invested in 4. Today, we're going to talk about a 5th that we would like to invest in. And if we can raise a significant amount of money before March 31st, which is the last day to invest in the fund, we have a 6th project that we would consider. We've said from the beginning that we would do high-rise, mid-rise, low-rise, and rezoning. What I'll tell you today is that we will not do high-rise. So we're really focused on mid-rise, low-rise, and rezoning. Purpose-built rental as well. Our market is Southern Ontario. We just believe there's the fundamentals of supply and demand here, and we know it. It's our backyard, and we know the developers. We know all the industry players, and it's just a safe place for us to deploy capital. And we're targeting total returns of 105%, IRR of 17, annual returns of 19.1, and it is RSP and TFSA eligible. and there are 4 years remaining on the timeline. And I'll go through the timeline a little bit later. But if you invest today, you get the benefit of the 4 investments that we've already made, which have already started. So that's why it's only 4 years remaining. So the fund's philosophy, we're going to be equity partners with experienced developers. We're going to diversify across a variety of projects and different developers. We're going to structure our deals with priority hurdles for the fund, so the fund gets the first money out of a project. We're going to have governance rights and protections for investors, where we're going to make the developers come to us for certain major decisions. And our plan here is to mitigate downside risk while maximizing returns for the fund. And so people say all the time, oh, I've got a lot of real estate already. I own a couple condos, or I have a strip mall, or a place in Florida. Real estate is different from development. Development is different from other real estate. Development is really the manufacturing of homes. It's based on supply and demand. We're basically going to an area where we think that people will want to live. We're going to pre-sell and pre-construction. Majority of the units are sold before they're built, which de-risks construction. And then we're going to build them and sell them and then move on. We're not staying in that project. We don't have to worry about the long-term longevity of the value of those units or the rents. We just need to worry about it at a single point in time when we sell them in pre-construction. And so the pre-construction prices are based on a forecasted profit margin over the budgeted construction costs. And so that's key, because if you don't show a profit margin, you won't get your bank financing. And so that's what the prices are based on. They're not really based on the resale market. And you can see in certain cases, in certain markets, there's a big disconnect between pre-construction prices and the resale market. And that's not because they think the future resale market is going to be there. It's because it's cost plus the margin. It's not based on legacy rents or current resale market. And so benefits of investing in the fund: it's a diversified portfolio. You're uncorrelated to public markets investments. We have a variety of build forms, variety of builder partners and locations, and we also put our promoter carry on the fund back end. So investors, will show you later how investors get their money out ahead of us. Long-term investments, so developers require patient capital, and because it's patient, they're willing to pay a much higher return for that lack of liquidity. So you're not having to worry about trading. You're putting your money in, you're leaving it there, and at the end of the fund's life cycle is when you get your exit. And we'll show you there's a few, as each project finishes, you're going to get money out. So you don't have to wait for the entire fund to finish, but each project finishes, you'll get your return of capital and share of your profit. And again, it's dependent on market timing of the sales launch. And as I mentioned before, the pre-sales are de-risking the construction. Today we're getting opportunistic deal terms. This is a really interesting thing that's happening in the market. There's a ton of great development projects we've been looking at, and they just keep coming in. We've got more deal flow now than I think we've ever had, and they're actually really good deals, great opportunities to invest. And because there's not that many people investing, we're able to get opportunistic terms. So if we have the capital, we can take advantage of that. And we're definitely using our structuring to mitigate risk and put more risk on the developer. And as I mentioned, it's RSP and TFSA eligible, which is great for long-term patient investments to build wealth for retirement with low volatility. So I think I mentioned before, our current focus, we're looking at low-rise, which is ground-related housing. Townhouses is the one we like the best, but all kind of low-rise housing, which is an end-user focus. Mid-rise, 6 to 19-story buildings, also an end-user focus, mainly because they can see that they can move in 2 years after they buy, as opposed to 4 or 5. And then purpose-built rental, which is basically building apartment buildings, multifamily buildings, and because of the HST and the CMHC, we think there's great opportunities now that were not there before. And then entitlements, and we'll show you one that we did where it's rezoning land for higher density in the future. So we're not as concerned in the current market. We want to make sure that the project has enough cash flow to carry through the rezoning and waiting out the market until it's the right time to sell the zone site to a developer. And so I'm just going to talk about the portfolio. We've made 4 investments to date. The Plaza Upper Markham Village, it's a low-rise project in Markham. The Fairview Towns LP, this is a stacked townhouse project in Scarborough near Fairview Mall. The Thelma Avenue LP, this is a boutique luxury mid-rise building in the heart of the Forest Hill Village. And 1095 Kingston Road, which is a rezoning play in the Kingston Road corridor in Pickering. And so just to get into each one and a little bit, the low-rise project in Markham, it's on the border of Markham-Stouffville. Plaza Corp's the developer. We've invested $7.5 million. It's almost 600,000 square feet. We're going to be building 113 single-family homes and 105 townhomes. It's approximately 3 years from now until its completion. We're projecting 107% return and 35.7 annual. If you look at the map here, the site is there. It's the north end of Markham, right on the border of Stouffville. It's closer to the Stouffville City Center than the Markham City Center. And what you'll see is that we're not the only developer in this block. The entire block has been rezoned, and on the Stouffville side and the Markham side, it's a group of, I think, 4 or 5 developers that will be building homes in this block. And you can see the 2 GO stations. I think they're probably pretty similar distance. I think the Markham one might be a couple minutes further, but the Stouffville one is within a 10-minute drive. And so here's what we're doing. You can see the light yellow is the single families, and the darker yellow is the semis. There is an even darker yellow that says apartment complex. That is not ours. That's someone else that is building that. So you can see here, this is some nice green space in the middle, and we're going to be on 19th Avenue and McCowan Road. And so I'm not going to spend a ton of time on this slide, but just to give you a feel, the singles we're going to be priced at 1.8 million and the towns at 1.5. Keep in mind, these are big units. They're going to be over 2,000 feet even for the towns. The profit on the project is $40 million. What was really interesting for us is the land. We are in the deal at the cost, which is $64 million. And once the site got zoned, it now has site plan approval. But once it got zoned, we had an appraisal and the land was worth over 100 million. So we're talking about making 40 million in profit, but we believe there's already a land lift that would represent about a $40 million profit already without even building. So a great kind of place to be. The singles, as you see here, are 641 per square foot, and the towns are 592. So they're pretty big units. We're calling for a total return of 107%. The second one is the stacked townhouse project with Profile Developments. This is near 401 and 404. Family-oriented housing, reasonable pricing. We like to call this attainable housing. It's a great location, really close to transit. We've invested 1.5 million into this project for 64 stacked townhomes. They are just in the process of finalizing the zoning with the city, and they will look to launch sales later this year. They're projecting a return of 123%. And just to give you some more on the site, this is the site. It's near Highway 404 and 401, and lots of amenities at Fairview Mall. Consumers Next is the 2nd largest employment center in Toronto outside of downtown, and then you have the subway station at Fairview Mall. There's one bus that goes right by the project, right into the subway station at Fairview Mall, and going the other way, it goes right into the GO station. So easy access to get downtown, either subway or GO train. And so here's the site. You can see it's 2 houses that actually reach a full city block long backyards. It's about 1 acre total. And when we put our project on top, you can see this is the 64 stacked towns and 2 building structures. And when I show you a little bit of what it looks like, the upper units are going to be more condo-like. There's going to be a hallway and a common entrance. And so you enter your unit from the hallway, kind of like a condo you would. And it's still a 2-floor unit, 2 bedrooms, and you have a rooftop patio. They're about 1,063 square feet, and the sale price is just under $1 million. So if you were buying a condo at Fairview Mall, as an example, for $1 million, you're lucky to get 600 square feet. So this is a much better option for someone who has $1 million budget and wants to get a decent sized unit. The townhouses are even nicer, more family oriented. They're 3-bedroom units. They also have a basement. They're 1,383 square feet, and they're estimated to sell at just under 1.2 million. And those ones you would walk in from the street. So you wouldn't have a common public corridor, you would have your own entrance. And so for that, we're average sales of 1.1 million. We're calling for a profit of 12.2 million. Actually, we've been talking to the developer, and they're updating their pro forma. It's going to show, I think, a couple more. I think it's like 14 million now is what they're suggesting the profit will be. 891 per square foot, and 123% total return. The third investment is our land entitlement. This is our rezoning in Pickering from Plaza Partners. They're now called Resident. They changed their name recently. We've done a number of deals with them, and they're very good at taking the site and taking it through the rezoning process and creating value that way. This site is a retail plaza. It's in an area that the city of Pickering has already earmarked for development, which I'll show you on another slide. And the beauty of this is the rents can cover the carrying costs throughout the rezoning process, so you can be patient with the city and the market. We put 1.25 million in. So you can see they're looking at putting 4 towers on the site, which would give you 900,000 square feet. We're suggesting this is 5 years. Now this is already a year in, so 4 years from now. So we're talking about selling in 2028. Projected return of 144%. And so just to give you a little bit on the site, if you know Pickering, this is the Highway 401, and Frenchman's Bay comes out of Lake Ontario, and you can see kind of gets close to the 401. Our site is directly across from Frenchman's Bay. So when you put 4 towers on our site, you will have some great lake views right onto the bay. You're not far from the Pickering GO station as well. And as I'll show you on the next slide, the entire strip of Kingston Road, this is what's called the Kingston Road Corridor Intensification Plan. So the city of Pickering has come up with this plan. They want to see all of this high density basically between Kingston Road and the 401. They're going to put some transit line in there to connect into the GO stations, and this is the future of Pickering. And so our site is right there, and what we're talking about is putting 4 towers on our site, and we're right in line with what we're actually, the application that we're putting in is less than what the city of Pickering has said we could apply for in their plans. So just to give you an idea, we're buying it, we did buy it at 27 million, so it's about $30 per square foot based on the 900,000 square feet. Which would mean that you'd want to sell condos today at 1,075, which Pickering was able to achieve higher prices than that on the last couple of launches, although there haven't been any launches in a while. But the ones that did launch in 22, and I think one in 23, both got over 1,100. But what we're suggesting is in 2028, a developer who buys the site could in 28 sell it for 1,300 a foot. And that would get us a value of the land of 81 per foot, and that $73 million exit. So we're not suggesting that we're going to sell condos on this site or build the high rise on this site. We're suggesting that we're going to take it through the zoning process, and in 2028 or sooner, we're going to sell to another developer for that $81 a foot. And so the exit value works out to about 76 million. We have all of the costs there and the issuer proceeds. It's $81 per square foot on the 900,000 feet, and it gets you a return of 144%. And so our latest investment is a mid-rise condo development. This is a luxury boutique building in the heart of Forest Hill. It's called the Thelma Avenue LP from Dealcore Properties. It's as I said, a boutique luxury. It says 6-story, but it looks like the city's going to give us 7 stories now, so that's a great increase. In an affluent, desirable location, 32 exclusive units. We underwrote these projecting to sell them in the kind of 3 to 3.5 million range. We're investing 1.5 million. It's projecting a return of 150%. The thing with this type of product is it's unique product. It's in a unique location where buyers of that kind of product want to be, and it's not representative of the rest of the city. This is what we see where people sell their house in Forest Hill and want to downsize. They don't want to go into a 40-story tower. They want to go into a boutique building. They have the money. They don't need to borrow, so they don't have the interest rate impact. And they want to be in a beautiful, nice building in the heart of the Forest Hill Village. And so if you see where this is, Spadina and St. Clair. Spadina is the Forest Hill Village north of St. Clair, just actually north of Lonsdale. We're in that stretch of Spadina and Lonsdale, and our site is right on Thelma, which is literally where, if you know the Forest Hill Village, there's a municipal parking lot on the north corner of Thelma and Spadina that is basically the parking lot for the village, and our project is on that street. And it's a short street. It's only got 12 or 15 addresses on it, so and it goes to a dead end. And so just to give you a better feel here, so this is our site right here. As I said, the municipal parking lot is right there at Spadina and Thelma, and this is the Forest Hill Village. And so we're expecting about 100 million in revenue. That works out to about $2,000 a foot, giving you a $21 million profit. It's 2,000 a foot on the 61,000 square feet. It says 5 years, but we've already accelerated through the zoning process, and we actually think it's going to be less than 4 years to finish. So 150% total return on this project. And so what we're hoping to do is raise a little bit more money in the fund to make a 5th investment, and that 5th investment would be in a project that we've already seeded with our investors a couple of years ago. This is from Town Corp. It's called the Greenbrier Road LP. It's a mid-rise building in Bayview Village. When we first went into the deal, we were suggesting that we would build a 12-story building, and the city has changed the rules around zoning near transit, and there's a subway station right at the end of the street. And so we've gone back to the city and suggested a 19-story building. So that's the plan right now. We're not fully approved yet, but we expect to be shortly. This is a transit-oriented mid-rise in a great location with access to highways and amenities. We're proposing a $1 million investment. It's now a 204,000 square foot project, 271 units. There's 4 years left because we expect to get zoned very shortly, and we could even launch sales later this year. So just to give you an idea, this is the area. The Bayview Village Mall is just a couple minutes away. The Bessarion station is the one that is just at the end of the street, and so there's a bunch of other activity happening in the area, but it's a really up and coming. It's a great neighborhood, and with some of the new developments, I would say it's really up and coming in terms of a mid-rise condo site. And so you can see here there's some height already in some of the buildings closer to Bayview Village, but our site is right in here, and you can't really see from here, but directly across the street from us is another development application, and then just backing onto the 401 is another one, and both of those are asking for much higher heights than 19 stories. I think they're both in the 25 to 35 range, so it is going to change the neighborhood quite a bit. And at Shepherd, the end of the street, there are a couple of developments that are already under construction. So this is a neighborhood that's really changing, and we're looking forward to being a part of the future neighborhood. And so here we can show you the profit on this is expected to be 27 million on the 211 gross sales. We are talking about the sales price of $14.50 per square foot. And a 4-year time horizon gets us 109% total return. And so just to tell you a little bit about the fund leadership and our advisory board. So I'm Devin Cranson. I'm the president and CEO of Cranson Capital, and Anthony Heller is my partner. He's the president and CEO of Plaza Corp. Plaza Corp is one of the biggest developers in the country, having built over 10,000 homes, and really one of the leading experts in real estate development in Canada. And together we've put together a great advisory board. We have David Goldman, who's the former president of Gateway Newsstands, but very active, leading a mortgage fund and investing in real estate development all across Ontario and even into the US. Ronnie Mendowski is the former president of Pelican Woodcliff. Pelican Woodcliff is a cost consulting company. And so basically when a builder goes to get construction financing, the bank will appoint a cost consultant to manage the withdrawals on the loans, provide progress reports. And so the cost consultants are really experts in everything construction and construction financing. And so having Ronnie on our advisory board has been a great asset for us. Tony Morrow is a bit of a legend in the city. He is the founder and principal CEO of TMG Builders. Tony was the president of Tridel up until 2008, and he left Tridel to start TMG. And TMG has gone on to become, I think it's the biggest condo developer construction company, more construction company than developer in the GTA. You can see their green signs on many buildings, and Tony's been a great asset for us, having him on our advisory board and getting to run these deals through him and get his feedback as well. And Shlomo Marder is the Chief Financial Officer of Nortown Electric and the Marder Family Foundation. The Nortown Electric is a trade that does a lot of the electrical work for a lot of the condo developers across the city. So Shlomo has that interesting perspective, but also the Marder family have been big investors in real estate development for 30 years. So lots of experience with lots of different projects. And so just to give you an idea of the time horizon, we're in our fundraising phase. It actually ends March 31st, 2024. So we only have a month left where people can invest in the fund, and then it's closed. And our deployment period is till the end of 2024. So if we do get additional capital to deploy, we have to deploy it by the end of the year, which is not going to be an issue because we have so much great deal flow right now and great places to invest. And the development period started in Q3 2022 when the first project started their development, and it's going to go right through to Q2 2028. And we do expect that we may start to see some distributions in 2026. For sure, through 2027, we expect to make distributions as projects finish and into 2028. And so just to give you an idea of how the profit's distributed, first investors get 100% of return of capital before there's any split. And then after that, investors will receive 90% of the profit until they reach 10% return, annual preferred return. And then after they've reached the 10%, they get 75% of all of the profit going forward. And so what does that look like on 100,000 investment? As an example, you first get your hurdle, first you get your return of capital, the 100,000, then you get your hurdle where you're getting 90% up to 10. So that's 56,000, and then you get 75% of everything above, which gets you another 48,000, which gets you 105,000 in profit. So you get your 100,000 back plus your 105 profit, you get 205,000 back when these projects finish. And so just to give you an idea of the timing and how that's going to come out, you invest now in Q1 2024, we have our development period, and then we expect that in 2026, we should be able to finish a project and have some return of capital. And then 27 will be some more. By mid 27, you'll have all of your capital back and start to get some profit, and then continue as other projects finish. And here it's showing Q4 27, but I do think that the entitlement play in Pickering may go into 2028. And so to summarize, we're raising up to $25 million. It's a minimum $25,000 investment. It's RSP and TFSA eligible. We have a mutual fund trust, which is what you would need to invest in if you're investing in RSP and TFSA. We also have a limited partnership where the minimum investment directly in the partnership is $100K. It's the same returns. Just sometimes when investors are using a corporation to invest, they like to invest in limited partnership for some difference in tax treatment, which is that it's active income. But if you're using your RSP and TFSA, the mutual fund trust is the way to go, and you won't have tax. The management contribution is $3.5 million. Asset management fee of 1.5% of deployed capital paid annually. The profit split is 90% of the profit to investors until they reach a 10% annual return, and then it is 75% afterwards. We're expecting a total return of 105.3, an IRR of 17, an annual return of 19.1, and the fund has 4 years remaining. And we do provide quarterly updates and annual financial statements. And so with that, I will open the floor to questions. I see some questions have started to come in, but I would ask that you please put your questions into the question section, and I will try to address them. The first one is, how many of the investment opportunities have you had? I guess they're talking about in general, not just in the fund. So we showed earlier there's 24 active projects that we have right now. They're asking if there's ever been investors receive less money than anticipated, and the answer would be yes. It's also the other way as well. More of the projects have exceeded expectations and have a higher profit return to investors. But there are certainly some projects that haven't, including one that dealt with a huge increase in lumber costs through COVID and caused some challenges on their project. That was probably the one that's the worst scenario. Investors still got all of their money out and some profit, but not the profit that we were expecting. But the majority of what we've done, the heavy majority, almost all but that one, have exceeded expectations. And that's just development. And that's kind of why the fund makes a lot of sense, because I could tell you, and I'll give this story as an example. We have 2 projects that we started a long time ago. One was a high-rise in the Yorkville neighborhood, and one was a high-rise in the entertainment district. And in Yorkville, everybody wanted to invest. Great address, great location. We were oversubscribed. And in the entertainment district, we struggled to get to our full subscription. We got there, but it took a little more time and effort. At the time, I would have told you that I would have thought Yorkville was better than the entertainment district, but fast forward to completion of those projects, and Yorkville did okay. It hit its target. Took a longer time to get there. But the entertainment district, which also took longer, is coming out with the 360% return for investors. It totally blows away the projections, and I don't know that we'll ever repeat a 360% return, but I couldn't have predicted that at the beginning. So, it's a real reason why we came out with this fund, is that out of those 4 or 5 projects, I cannot tell you which one's going to be a home run and which one's going to be a single. I can tell you what I think they're all going to do. That's what I've presented today. I think they're all great projects. I think they're all going to hit those numbers, but inevitably those won't be the final numbers. They'll be either higher or lower or close, but they won't be the final numbers. When you invest in the fund, you have the diversification, and you get to capture the one that totally exceeds the expectation, and it helps offset one that may not reach their expectation. So that's one of the reasons why we created a fund, is that you can't always predict which one's going to be the big winner and which one may run into some challenges along the way. We definitely try to mitigate all the challenges, and we have lots of experience doing that. So someone asked, as you complete project, will you return capital and returns for those projects individually, or wait for all projects to complete? Yes, as each project finishes, the proceeds will be distributed to the investors. You don't have to wait for all of them to complete. Will the fund stay open, or will it be perpetual? If so, or the tools for evaluation and exit, it will not stay open. The fund is closed for new investment after March 31st. And from there, wherever we get to is where we get to. And if we have enough, we'll go into a 5th and 6th project, and then that will be it for the fund. And hopefully we'll come out with Fund 2 at some point. Can existing investors and individual deals roll over to the fund? No, there's no mechanism to roll over to the fund. You'd have to make a new investment into the fund. I can't even conceptualize how we'd be able to make that work. Can we hold the fund at TD Waterhouse and a TFSA? I think that's a TD question, but my hunch and our experience is that TD will not let you do it. The main thing is you need an advisor that's willing to do the paperwork for you, and TD is one that we haven't had success with. We've had success with CIBC, BMO, RBC, and Scotia. If your advisor is willing to do the paperwork, you can hold it in your RSP or TFSA at any of those 4 banks. If you don't have an advisor, or if you're at TD or one of the other banks, some of the boutique shops will let you do it as well. But we work with Questrade and Olympia Trust, and they're both set up well to hold private placements. And you can do a transfer from TD Waterhouse to one of those, and then you can hold it in your TFSA at either Questrade or Olympia, no problem. And we can help you opening accounts at both of those places. Someone asked if we could get a copy of today's presentation. Not a PowerPoint version, but we will send a link of the presentation so you could watch it again. Securities Commission doesn't allow us to provide multiple presentations, so the actual investor deck is the one that is the printed presentation, and we can send that to you, and that has a lot more details than what I presented today. Someone asked about a completely different project that's not related to the fund at all, and I'll tell you that we'll take that conversation offline. We do send out quarterly updates, and on that project there was an update in the fall, and there will be another update in March. So we can definitely update you on that one outside of this conversation. And another one asking about another project. So you know, I get that people want to know. I talked about the market in general, and some of the projects that you're asking about are the land development where we're taking them through rezoning, and it's been a few years. I can tell you in general, it's not a good time to be selling land right now. And you know, we could try to fire sale it just to get out early, but I don't think that would be the right thing for investors, especially with all the things I said earlier. We do expect that interest rate relief is coming, and if we were to wait 6 months or a year, we do believe the land market will come back. And so I know that some of these rezoning projects have taken longer than anticipated, but that's a subject of the market. And the beauty of those rezoning projects is that we have the cash flow to carry. So we're not going to be forced into a fire sale. We're not going to be backed up against the wall. We have the flexibility to continue to hold and wait for the market to come back. And we do expect that all of those projects will do really well. They've all increased in value since we've bought them. And when the land market comes back and people are buying land again, we're confident that we'll get a great exit. Someone asked, who are the other investor groups investing alongside the fund in these projects? So in the first one, which was the Plaza Corp Upper Markham Village, the developer and the landowner are the joint venture partners. So they put in 23.5 million and came to us and asked for 7.5, and that's all just 3 groups in the deal. And we never went out to investors with that one. It was just the fund, and that was it. The next 3 were all projects that Cranson Capital Securities, as an exempt market dealer, was engaged to raise money for those limited partnerships. And with those 3 projects, we put individual investors into those deals, and the fund took a piece of each deal. So the partners in those deals are Cranson Capital clients directly and the fund. So someone asked to please describe the positioning of investors in the fund versus individual projects. Not really sure what you mean, I guess. There are individual investors in each project, and they bought the same units as the fund. The only difference is with the fund, if you're an individual investor in one of our LPs, you'll notice that Cranson Capital takes a carried interest. After a hurdle, the C units usually take a portion of the profit. When the fund invests in those projects, that carry goes to the fund. So, because there's a carry on the fund. So we don't take a carry twice. So if you're in the fund The fund will actually have a higher return on each project than the individual investors because the fund is getting a carry, but then there will be a carry that we take from the fund's returns. But the idea is that we're putting our carry at the end. So on each individual project, we're on the end, but we didn't want to take a carry on each project from the fund at the time the project finishes. So if one project finishes early and we would get a nice carry, that's going into the fund and it will go to our carry at the end. If another project doesn't provide a carry, it's going to hit us, not the investors. So that's the idea of putting our carry at the back end of the fund. And that's why these projects, if you're an individual investor in one of them, it looks like the fund's getting a better return because at the beginning, the fund is getting a better return because it gets our carry. Is the return on investment interest income or dividends? So that's a great question. So when you invest in development, at least at the limited partnership level, it's considered active income. So it's active business income. If you're using the mutual fund trust, it's passive income, and that's where it's RSP and TFSA eligible in the mutual fund trust. So it's never interest income, and you should get a better tax treatment than if you invested in, say, a mortgage fund or something else that pays interest. Will my investments be in all the projects shown in today's presentation? Yes, absolutely. That's the whole idea. You'll make one investment and you'll get the benefit of all 4 projects. And if we can do a 5th and 6th, you'll get the benefit of those as well. Someone asked if today's slideshow will be sent to individuals. We will send a link to the webinar so you can watch it again, as I mentioned before. And then I think it's the same kind of question. Will our investors be part of the development starting in 22 and 23? And the answer is yes. Someone again is asking about one of the land development deals that we did, so hopefully I answered that question. Do you know percentage of buyers unable to close in the current market? That's an interesting question. I can tell you we're finishing a project in the entertainment district I mentioned before, where we sold the majority of the condos in 2018. So if you think about all the high-rise businesses out there, they're 4 or 5 year projects. They were sold in 18 and 19, and they're finishing in 24. When we sold, our average sale price was around $915 a foot. Today, the resale market in the entertainment district is over $1,200. So we don't think anyone who bought at 900 is going to default when the value is 1,200. And if they do, we'll probably be able to take their deposit, their 20% deposit, keep it, and then sell the unit in the market for, we don't even need 1,200 because we've got a 20% deposit. So we're not worried about people walking away when they bought in 2018 and 2019 because there has been enough of a lift through the construction phase. Now, if you're looking at other projects where maybe the developer sold in 2021 and like low-rise projects or others where they're shorter duration, those could have some challenges with closing because the values in pre-construction in 21 and 22 probably aren't there in 24. So if you're looking at that, there is probably some challenges in closing risk in the market in projects that sold then. But then going back to some of our projects, the ones I mentioned at the beginning where we sold in 22, they're all still ahead of the market. They're still below market. So the houses at Huntingdale that we sold today, you would pay more for that house, and we got a 20% deposit. The units at Young and Finch we sold for $1,350. Today, I think you'd pay that. I mean, we'll be finished for 2 more years, so for sure, I think by then it'll be there, and we got a 20% deposit. So we're not viewing too much closing risk on much of our projects. I think if you, as I said, if you sold at kind of peak pricing in 21 or 22, and now you're finishing and your pricing isn't there, there is some risk, but you generally have a 20% deposit, and I don't think the risk is 20%. So you can probably keep your deposit and resell. And one thing that we've just started to see in the market is that if someone doesn't close on a unit, a developer can sue the buyer. So I don't expect that many buyers to default. I think the people who will are people who absolutely have no way of filling in the gap or selling the unit. So we do see it as a challenge for some very specific projects in the market, but not in general. So someone asked about I talked about the project in Markham, how there was a $40 million lift in the land, and why wouldn't we just sell the land? It's not, I don't think it's something we could do. I think that the land lift is on paper. We always say when people come to us with land lifts that when we invest in a deal, we want to invest at cost, and the land lift is really only there when you finish. So we always tell developers, put your land lift in the waterfall at the back, because if you don't finish, you don't get the land lift. So, would someone buy that site from us for $100 million right now? Maybe, but I don't think so. I think that land lift is a paper lift that comes into play with the banks when we go do our construction financing, and we get credit for it. And really, it's value when we finish the project. So, could we sell it for more than we bought it for? Yes, but that's not the intent. Someone asked if they could invest through a limited company. Yes, any Canadian corporation can invest, whether it's a limited or a corporation is fine. So if that's the question, then the answer is yes. How do I submit a deposit if I want to invest? So if you're interested in investing, then reach out to one of the Cranson Capital dealing representatives. If you don't have one, you can call us at 416-595-5550, or send an email to info@cransoncapital.com, or go to our website, cransoncapital.com, and fill out, there's a form to fill out, and we'll have one of our dealing representatives reach out to you. If you are interested in investing, you just have to let us know the amount that you'd like to invest and how you're going to invest, whether it's going to be personal or through a corporation or through your RSP or your TFSA, and then we can organize the paperwork for you and go from there. So someone asked how confident that the projects will reach the price per square foot projections given the current market. Pickering's hoping for about 1,000 right now and 13 in the future. I think Pickering's the one that's really interesting, because we're not talking about selling condos there. We're talking about selling the land. And it's not going to be till 2028. So that means a buyer in 2028 is going to think, can they get that 1,300 in 28 or 29? And what I was trying to illustrate earlier in the presentation is that we're going to have a huge problem in our market in 27, 28, because there's not a lot of units being finished. So, well, it's hard to fathom today that prices are going to go up $200 a foot over the next couple of years. And in 24, there will be a bunch of completions. So you may see prices actually come down in 24. I can guarantee you that in 27 and 28, prices are going up. I don't expect interest rates to be, high in 27, 28. I expect that, what Benjamin Tao was saying, that 3% is going to be our new target. And if interest rates are 3% and we're delivering very little new housing in 27 and 28, I'm very confident that you'll get 1,300 a foot in Pickering. So that's kind of our view, that anything that is that far out is going to just be expensive, because it's the only way to go when there's no supply, is that prices go up unless demand goes away, and I don't see that happening. So someone asked about another one. One of the land deals, if they're closing, can they roll it in? As I mentioned before, I don't think any of the land deals, at least before March 31st, are going to get you any capital. The land market is not there. They have been looking at selling sites and talking to buyers, but as I said, it doesn't make sense to sell today at the prices, especially if we believe in 6 to 12 months, interest rates are going to go down and the market's going to come back, and the land market will be there and you can sell for a much higher price. So if you're thinking about recycling money out of one of those land projects, I mean, we're the final day to invest in the fund is March 31st, and I can guarantee there won't be any capital coming out. Even if I knew of a project today that was sold, it would still take a couple months to get your capital out for closing and all the wrapping up. So it wouldn't be possible to roll into this into the fund. So that seems to be all the questions. I'll give it a minute or two. If anybody else has any additional questions that they want to ask, I'm happy to answer. But I will say I appreciate everyone's time today and thank you for joining us. And if you are interested, please reach out to someone from our team. We do have March 31st deadline. And if you are going to use your RSP or TFSA and you have to transfer, that takes about 2 or 3 weeks. So if you're planning to use one of the registered accounts, you probably need to get to us this week or next week in order to make that March 31st deadline. So please keep that in mind. If you're using a corporation or personal investment, then you have a little bit more time. And tomorrow is the last day to make RSP contributions. So, you know, you can make your contribution tomorrow to your RSP account and then use those funds to invest in the deal. It's kind of great timing to be able to put some of your RSP money into a great offering. So there were no additional questions. So with that, I'm going to say thank you very much to everybody for giving me your time today and listening to the webinar. And hopefully we will see all of you participate in the fund and we'll all make lots of money together. Thank you very much.